As the old saying goes, when the going gets tough, the tough get going. And by virtue of being the chairman of the US Federal Reserve, the responsibility of reviving economic growth, for better or for worse, sits squarely on the shoulders of Ben Bernanke. Tonight, global markets will look for just two words in the Federal Open Market Committee statement: quantitative easing. One section of the market expects the FOMC will announce an extension of its controversial bond buying program, Operational Twist, a $400 billion bond buying program set to expire at the end of this month. This program involved swapping US government bonds with a short maturity period for those with a longer maturity. The idea being to flatten the yield curve at the long end, which serves as a reference for the pricing of auto loans, mortgages and other long-term loans to consumers and businesses. But the evidence suggests the program has not really helped the average American. Until recently, federal governors were divided over intervening further in the bond markets, as they were unsure if the economy was weak enough to require it. But data ranging from consumer sentiment to industrial production to hiring now point clearly to deceleration of growth. Faced with coming elections and ongoing problems in Europe, the Fed is under pressure to act now, before things get any worse. With Venkatesh Rao, Faye D'Souza, ET Now.
We've got a special guest joining us live on Business Tonight with more on what really we can expect from Ben Bernanke in a little over an hour and a half from now. Rob Carnell, Chief International Economist from ING, Johnson from London with his expectations. Rob, thanks for joining us right here in Business Tonight. All eyes obviously on that crucial Fed meet. First up, do you believe there's a case for another QE or QE3 as everyone's expecting? And if it does happen, how would that impact markets like India and Asia?
I think right now there probably isn't a case for QE. The argument for QE would be along the lines that there was a big deflationary risk for the US, and all the evidence suggests that whilst the US may have slowed a little bit in the last month or so, it's still ticking along at a positive rate. 2% might not be great for the US, but relative to the Eurozone, it looks pretty good. So a real case for QE, they always talked about there being a big hurdle for it. I don't think we've got over that hurdle yet.
Rob, the other expectation is an extension of the Operation Twist. Do you think that would be a more logical thing to do by Ben Bernanke?
I think that's not only more logical, but if they didn't do it, it would be a real head-scratcher. I mean, Operation Twist, while you could argue that it's pretty ineffective, every month, every week that the Fed shifted its portfolio of assets from shorter to longer, it was doing something that it felt was adding to the stock of stimulus in the economy. Now, to stop doing that effectively means that the Fed would be adopting a tighter monetary stance than we've seen over the last 6 months. So whilst I don't think we've crossed the hurdle for QE, I certainly don't think that the conditions warrant a tightening of policy, which is effectively what not doing more twist would be today.
But here, Ron, the important point is that QE2 didn't serve any real purpose, at least not to lift the economy out of the doldrums, because all it did was cause a broad-based rally in commodities, something that EMs or emerging markets benefited a great deal at one stage. However, what is important to see is whether the commodity impact will be played up further. Will we continue to see an effect on short-term emerging market play?
Yeah, well, QE2, I suppose, was the precursor behind a lot of the comments about currency wars. So you had the Brazilian finance minister in particular coining that phrase. Big concern that a lot of the credit that was being generated was just flowing overseas, stoking asset bubbles in countries that didn't necessarily want them or need them, and putting up commodity prices. Now, I think one of the arguments behind QE3, if it were to take place, would be that it would be a kind of sterilised QE. In other words, whilst they might target a particular area of the yield curve to push yields down, they wouldn't be generating extra liquidity as such, and you wouldn't get this dollar effect and the impact on the commodities as well, which would all beg the question, why on earth would you bother? Frankly, it would seem a completely pointless thing to do. But that's one of the arguments behind a variant of QE if they were to carry on going in that direction.
But Rob, there's still a lot of weak economic data coming out of the U.S. on a regular basis. Do you think instead of doing a quantitative easing sort of move, it could help if there was more direct lending to the right sectors?
It's quite possible that a sort of more focused QE might work better. This would be, I think, more like the sort of credit easing that Bernanke has always suggested he was more in favour of. I mean, the evidence that, for example, QE has lowered mortgage yields is fairly patchy. If it has done that, it's done so very inefficiently. It's done far more if it has brought down treasuries, it's brought down treasuries, and the others have followed, but with some lag and not nearly to the same degree. So, yeah, there's definitely an argument for chopping up QE, having another look at the way it's operated, not thinking solely in terms of treasuries, but looking at a much broader range of assets.
Rob, even if we had another Operation Twist, do you think it would be as effective given that investors have already moved a lot of money out of Europe and into US treasuries?
Well, I don't think Operation Twist 1 was effective, really. Actually, if you look at the first month or so of its operation, it's hard to see there being any impact at all of this shift out of shorter-dated maturities into longer ones. If anything, in the early period of this, you actually saw the yield curve steepen, exactly the opposite of what was expected. And I think much of the decline we've seen in the longer end of the yield curve since then has owed far more to the developing conditions around the globe, so the crisis conditions in Europe, and just this rush for safe haven assets. I think that's really what it's reflecting. I very much doubt that the Operation Twist 1 did anything. So Operation Twist 2, the other thing that we think we know from these various types of quantitative easing and unorthodox policies is that they have some effect the first time you do them. The second time you do them, they don't have very much effect. And to the extent that they do anything at all, it's probably all through the kind of announcement effect, the getting across a message and affecting people's perceptions and expectations. I don't think QE 2, 3 or any new form of twist would do anything positive.
Rob, final word. Should conditions worsen in Europe, is there the likelihood of Fed actually opening a special window for US banks with exposure to European institutions? Do you think that might help restore confidence in American banks?
Yeah, I mean, it's quite clear that whilst the US banks don't have very direct exposure, say, to peripheral European bond markets, they do have quite a lot of exposure to the European banking sector, and they have exposure through the CDS market. I think some of the largest US banks have written most of the CDS protection on European peripheral debt markets, and they probably hedged those positions with each other. So there is a risk there that there will need to be quite a lot of assistance given by the Fed in those events, because the flows between banks are likely to dry up very rapidly in the event that there's further deterioration in the Eurozone. So yeah, I think that's a very, very distinct possibility.